I'm Shane Balkham, Client Investment Director at U Asset Management, and this is the video covering the fourth quarter of 2023. The last quarter of 2023 was overall positive for markets, although it started with continued pressure from central banks that interest rates had to stay higher for longer, adamant that inflation was still yet a major threat to economies and stock markets. That dissipated through November and December when we saw from the US Federal Reserve, the European Central Bank and the Bank of England maintain rates for 3 consecutive meetings. The expectations from markets were that inflation had indeed been beaten and focus would quite rightly move to supporting the economy as weaker economic growth throughout Q4 permeated through developed markets. This led to a broad rally through most asset classes. We saw inflation continue to drop through Q4, notably in the UK, dropping from 6.7 to 3.9, well below expectations. On the downside, we saw growth in the UK revised downwards. We had a flat Q2 and Q3 had a slight negative return. This in turn should shift expectations for central banks from keeping interest rates high in order to combat inflation to cutting interest rates in order to support the economy. How did this affect your investments? The last quarter of 2023 was positive. Although that performance was in the last 2 months of the year, November and December, again highlighting the need to make sure you stay invested throughout the cycle, albeit the last quarter is an extremely short time period to be comparing. It was positive performance across all investment ranges and all risk profiles. Taking it through to 2023, we had a positive year as well. Much needed after the negative year of 2022, albeit in 2022 we did drop significantly less than our peers and our comparators. Our longer term returns continue to be extremely strong, over 5, 10, 15 years, and since launch, and this is our 20th year of running the model portfolios, we exhibit strong long-term returns. In fact, 99.6% of our clients' assets over those time periods have beaten the respective investment association sector average. What of the outlook though? 2024 brings with it something 2023 didn't have, and that was politics. Over half of the world's population will be going to the polls this year, covering off 76 different elections. It also covers off more than 2/3 of the world's economic growth. First out the blocks was Taiwan. The incumbent Democratic Progressive Party won a 3rd consecutive term in power. Now, the importance here is the DPP consider Taiwan not to be part of China, and the risk was this was going to exacerbate Chinese-Taiwan relations. However, DPP won less of a majority than they have in the past. This lessens the risk of a conflict between China and Taiwan at this moment in time. The 2 key elections this year, which will considerably gain a lot of media coverage, will be the UK general election and the US presidential election. We expect the UK general election to be first. We have a budget in March. We expect probably sometime in the late summer, early autumn, maybe September, we will see a UK general election called. In the US, we know that's going to be November for the presidential election. And we're already seeing a rollout of campaigning already starting in earnest. First off will be the campaigning for the Republican and the Democrat nominations. It is likely that we will see Donald Trump as the Republican candidate and Joe Biden as the Democrat candidate. This will be unusual because both candidates will therefore have already been a president at some stage. Now, markets generally and historically don't really care whether blue or red wins. Markets tend to look through this. So for us, none of the politics in question are going to demonstrably change our long-term or short-term views in terms of how we invest. What is more important to us are central banks. We're still at a point of the cycle where policy risk is still a significant danger. We need central banks to start cutting interest rates in order to support economic growth. In our view, inflation has already been beaten. Markets are expecting upwards of 6 cuts this year, particularly for the US Federal Reserve, although the US Federal Reserve are only factoring at this moment 3 interest rate cuts. As growth is revised downwards, we need that support from central banks in the form of interest rate cuts. It'll be interesting to see as inflation falls what pressure that puts on central banks to actually initiate those cuts sooner rather than later. If we see inflation dropping anywhere near their long-term expectations, the worry of deflation may push them to make cuts sooner rather than later. From our perspective, we are cautiously optimistic. Yes, we'll see volatility in the form of rhetoric from politicians trying to get elected again for another term. However, we believe we're at the peak of the interest rate rising cycle, and the next move from central banks will be interest rate cuts. This will be supportive to long-term assets. Thank you for watching. More detail is contained in the quarterly reviews, and I'd urge you to read that. If you do have any questions, please don't hesitate to reach out to your financial advisors.